Hey class, so this is chapter 2, and this is a problem that is similar to your homework. It might even be the same. We do algorithmic work in this class, which means y'all may have the same question with different numbers. So when I go through these examples, if you see similar numbers, don't worry about it. If you don't see similar numbers, don't worry about that either. I just really want to talk to you about the terminology in chapter 2 and try to help you as you go through the homework assignments. And I'll do this different ways throughout the semester. Sometimes I work in Connect, as I am now, and sometimes I work in Excel, and I may bounce back and forth today to try to help you get started with this. So this is a contribution margin format versus a traditional income statement. And when we say traditional income statement, and I'm going to go over here into Excel, what we mean by that is what we see according to generally accepted accounting principles. And generally accepted accounting principles govern the way that we put financial statements together. And the reason we have those standards is so that we have uniformity across the world of business in reviewing financial statements. If everyone did theirs a little bit different, then bankers and investors would have trouble trying to figure out what was going on. So generally accepted accounting principles says this is the way that we want you to do these income statements. In a traditional income statement, you'll start out with sales, and then you'll have cost of goods sold. I'll have to pause every now and then. I videotape at home, and I have 5 dogs. We have a new one, 5 dogs. So I apologize. So you have sales minus cost of goods sold, which gives you gross margin. And from that, there's different ways, but basically you're going to have your operating expenses. And the way this one is set up, you have selling and administrative expenses. And we can start by listing our selling expenses. And then we can list our administrative expenses. And I'll talk about those in just a moment. And then we have our total selling and administrative. And then we have our net operating income. Now, you know there's also income tax and interest expense and things like that. But for now, we're just going to focus on what these mean and compare the difference between this and a contribution margin income statement. And so with sales, so for example, if our sales were $100,000 and our cost of goods sold, and that is exactly what it means, the cost of the goods that we sell. So if we sold 100,000 units at $1 a piece, and those units cost us 25 cents each, then our cost of goods sold would be $25,000. Our gross margin is simply our sales minus our cost of goods sold. And then we list our selling expenses, our administrative expenses, and if our total selling, well, I'll just go ahead and throw some numbers in here for you. And then if our total selling and administrative is $35,000, our net operating income is our gross margin minus our total selling and administrative. So in effect, we took our sales minus our cost of goods sold minus our selling minus our administrative and came up with a net operating income of $40,000. Just an example. If I'm doing a contribution margin income statement, then I'm setting it up a little bit differently. Now this is internal. So one way to remember, this is something you would see external. This is what I would give bankers and investors. This is more of an internal statement that we would use to make decisions about our products. And we'll get into more of that as we get into the chapters. But what we do in a contribution margin income statement, we start with sales and then we list our variable expenses. And then we have our contribution margin. Then we list our fixed expenses, and then we have our net operating income. And it should be the same. Sales are the same. But what we're doing is we're looking at each one of these expenses over here, cost of goods sold, all of our selling, all of our administrative, and we're determining what is fixed and what is variable. And that's how we make decisions. Variable expenses vary with sales. So if I sell a product, I have the expense. Fixed expenses within a relevant range, usually a year, do not vary. And so my rent, for example, I usually have to sign a 1-year contract, $1,000 a month. If I don't sell anything, I still have rent. And so variable expenses vary, fixed expenses do not. Well, if we know what our contribution margin is, and let's just say that our contribution, our variable expenses are $25,000 and $15,000, then that makes us have a contribution margin of our sales minus all of our variable cost, or $60,000. So I have a contribution margin ratio, contribution margin over sales, of 60%. So what that tells me is for every dollar of sales I have, 60% of that dollar is going to cover my fixed expenses and my profit. It contributes toward covering those. And that's what that means. And so if we were setting this up, our fixed expenses would be $20,000. So this terminology, what we're doing right here, we'll talk about this the entire 8 weeks that we have this class. So you need to make sure that you're very familiar with the terminology. Excuse me. So going back to this assignment, it tells us that we're purchasing pianos and we're selling them. So we are a merchandising company. The pianos cost on average $1,506 each. They sell them for an average price of $2,700. So there's your cost of goods sold, $1,506. There's your sales price. We know this $1,506 is variable, so we're going to come down here and we're going to say, okay, selling is $945 a month. That is fixed. Sales, salaries, and commissions, that's fixed, this per month. This 4% of sales is variable. Delivery of piano, that varies by sales, that's variable. Utilities, that's fixed. Depreciation. So you get the idea. You've got to figure out what's fixed, what's variable, so that you can go back and do this contribution margin income statement and use that to make decisions internally about your products. Now the other one that I want to look at with you, okay, I had to pause. This is the high-low method, and it's predicting cost. And so sometimes we don't know if something's fixed or variable. Sometimes it's both. And we don't really know 100% for sure what the numbers are, so we do an estimate, and we predict the cost based on the estimate. And we use one method called the high-low method. And so this is our total overhead cost. Overhead is anything that's not directly attached to the product. So direct materials, direct labor, everything else in the product is overhead. And so in April we had $219,000, in May $192,000, in June $246,000, and July $273,000. So the first question I'm going to say is it fixed? It's not fixed because it's not the same every month. So then I would come in here and I would say, okay, is it variable? So if I take my $219,890, I've got a calculator, divided by 51,000 units, I get $4.32. You can try that. $219,890 divided by 51,000, that's $4.31, 32 cents if I round up. Then I'm going to try the next month. I'm going to take $192,990 and divide by 41,000, and I get $4.71. Okay, so it's not variable. It's not fixed, it's not variable. So it's what we call a mixed cost. Part of it is fixed, part of it is variable. And so we can come down here and we can see this breakdown. For example, at the 41,000 hour machine level of activity, we see that our utilities are variable, our supervisory salaries are fixed, and our maintenance is mixed. So we've got to figure out of that $65,490 how much is fixed and how much is variable. So what we do is we're going to estimate how much of the $273,690 of overhead cost in July was maintenance. And so first you're going to figure out how much was utilities and how much was supervisor salaries. So supervisor salaries is fixed. That's going to be the same no matter what. And so then we're going to say, okay, well, how much of it was utilities? Well, we know utilities is variable, and we know at 41,000 hours it was $61,500. So if I take that $61,500 and divide by 41,000 machine hours, I get $1.50. So what that tells me is that my utilities are $1.50 per machine hour. I know that much. That's a variable cost. I know my fixed cost. And so I've got to figure out my maintenance. So this $273,690 at 71,000. So what I can do now is I can say, okay, 71,000 times 150 is my utility cost. That's 106,500. And guys, this is a video, so if I'm going too fast, you can pause and rewind. That's why I kind of go through these quickly, and I'm limited on my time as well. So I know I'm going fast, but you can always pause, go back, rewind, whatever you need to do to keep up. But I know that my utilities, I can figure it out that way. I know my supervisor salaries are fixed. And so the other cost, the other part of the $273,690 has to be my maintenance. So now what we do is the high-low method. And it talks about this in your book. There's an example you can follow. But what we do is we take the high level of activity, which is 71,000, and we take the low level of activity, which is 41,000, and then we take the cost of the mixed component that we're trying to break down, and at 41,000 we know that it's 65,490. And then we go figure out what it was at the 71,000. So that's what you have to do in your homework. And then what you do is you take the difference between the two. So this one, the 71 minus the 41, gives me 30,000, and I take the difference here, and then I take the cost divided by the level of activity, and I come up with the variable cost per unit. Now you're going to follow along the example in your book as you do your homework so that you can figure out how to do this, but I wanted to get you started on this one because you don't jump right into separating your mixed cost. It's a great problem. You may not have one exactly like this, but I tell people all the time in managerial accounting, don't get hung up on the word accounting. This is management. Yes, you have a lot of numbers in front of you. Yes, you have a lot of costs in front of you, but this is not hardcore accounting. This is management of numbers. And so step back from it and say, okay, if I was the manager and I was trying to estimate costs for the future, I would have to know what's variable and what's fixed. And if I have something mixed like this, I would have to separate that out. So get as far as you can on that. With your homework, you do have check my work options. You get 3 opportunities on your homework. But if you don't know how, if you're getting something wrong and you don't understand how, you're welcome to email me. Send me as much information as you can. For example, I'm in chapter 2. Problem 2, I am subtracting high of 71 from low of 41. High cost and low cost is this. I'm not getting the right answer. What am I doing wrong? And the more information you give me, the quicker I can answer your question and get back to you. So this should help you get started on chapter 2. And then if you have questions, you can email me. And we'll move on then to, once you get done with this, you'll be ready for week 2. We'll get into the next chapters. Thank you.